Welcome to Profit or Pitfall, where we'll take live questions from business owners and commercial real estate investors and answer them to the best we can to help people out who are looking at opportunities for themselves. And I'm actually excited to share a deal that I'm actually looking at the moment for actual purchase. This is a 160,000 square foot building in the Southeast market. It's got 12 tenants and it is a multi-building property on 6 acres, and I'll take you through a quick look. And it's basically this campus right here, all the way over there. And there's 1, 2, 3, 4, 5 buildings, and it's on 6 acres in a well-established market. You'll see right here there's the freeway, which is part of the criteria that we look at in terms of looking at industrial buildings. We want to have something that's very close, basically freeway adjacent or exit adjacent off a highway that feeds a major market. And so the goal is here to help you understand beyond the flyer what you might see. You just look at the cap rate or the gross rent multiple, and the hope here is to dive a little bit deeper, look at a financial model and kind of understand when a deal is a good deal, whether it's a profit or a pitfall, right? So here you might see that the year one cap rate kind of going in is at just a hair above 5%. The cap rate at the refi is at 7.62, but the terminal cap rate is 10.19%. So for somebody who's experienced, their immediate assumption would be like, well, you're walking in with negative leverage. And that is potentially true, but I think in the market that we're in now, if you're looking at something like this, where you're looking to create value add, this particular property has, like I said, a dozen spaces or bays, but one of the tenants takes up 2 of the spaces there, as you can see, the forklift and sales repair operator there. But the value that we see here is, one, there's lots of leases expiring, but these tenants want to stay. So they're very excited about having a new relationship with the potential new owner. This property was pretty neglected and very badly managed by the family that owns it. Looks like this was a very, very small part of their other portfolio. And so it just happened to get neglected. And so when we looked at this, we saw the opportunity to be able to look at these leases. And if you can see here, on this section here, there's the monthly per square foot or annual per square foot. These numbers are pretty low because if you look over where we did our MLA analysis, stuff should probably be in the $15 per square foot range, and that's an annual number. So what we're trying to do here is help you understand kind of what helps make this deal worth looking at. So let's go back to the pro forma, the informational page, and you'll see here there are 12 sets of metrics, and that can be kind of overwhelming, but hopefully once I walk you through here, you'll see how these numbers can make sense to you. So as I mentioned, the approach here is there is going to be some renovation work that will be budgeted into the purchase price of this particular project, along with what we call lease grooming. And like I showed you earlier in the rent roll review, there's lots of leases expiring here. And so there's an opportunity to, depending on the relationships that exist with these tenants, is to see if they want to stay. Many of them do, and help them understand that what they're paying currently is way below market and that the rents are going to go up potentially, and if they're going to be able to sustain that as time goes forward. So here you have 12 metrics that are could potentially be overwhelming, but I'll walk you through them. And so what I think it's important to understand is that these are critical for any investor or buyer to understand and analyze, to understand the financial viability and risk profile of a commercial real estate investment. And this is especially one involving renovation work and lease grooming, like I mentioned. So I'm going to break this down for you. And so if you look here, there is in the gross unlevered, gross levered, and net levered, 3 separate sections. And so basically the difference is for unlevered, you're looking at the capacity of the project without debt. Okay, and then levered is when you're looking at the impact of the leverage or the debt financing on the returns. And then the net levered returns are similar to the gross levered returns, but these are after all the property level costs, asset management fees, etc. So as you can see here, yield on cost is annual income generated by the asset divided by the total cost of the acquisition and the renovation. So in this particular instance, I'll show you here, we are looking at, there we go. Here's the purchase price. So it's a $26 million purchase price. And then we look at all the fees, the broker fees, the closing cost, the acquisition fee we're going to charge, the financing fee. And there's your $27 million, almost $28 million cost. And as you can see here, we show that there is some renovation funding that's going to be put in. We're expecting to put in about 60% leverage into this transaction. And we're assuming a market rate, very, very high compared to what we just saw 12 to 18 months ago. So we're at 7% on this transaction to be real about what the market is telling us. And as you can see here, even with these numbers, we're at an 8.4% debt yield. And the debt yield is important because what you're doing is you're taking the net operating income and you're dividing it by the loan amount. And this helps a lender understand their risk profile and measure the property's ability to cover its own debt. So it basically represents how many years it would take for the property's net operating income to repay the loan amount in full, assuming the NOI remains constant, which in this case it's not, because we're hoping to be able to raise the rents, replace some tenants with some better ones, and reduce that number. So from a risk assessment perspective, a higher debt yield is generally considered safer for lenders, as it indicates the property is generating. So from a banking perspective, a higher debt yield means it has a safer profile because it's basically the income relative to the debt service is higher. And this is important for an investor to understand, because a higher debt yield could mean more favorable terms when you're trying to get that loan for the acquisition. And while other metrics like loan to value or debt service coverage ratio are also important, the nice thing about the debt yield, it is not influenced by the interest rate or the loan amortization schedule. It makes it kind of a more of a pure indicator of the income producing capacity of the property in relation to the loan amount. Are you falling asleep yet? Hang in there. There's a lot of fun things we're going to learn today. Now, if we take a look at what looks like the acquisition portion, this is happening at the end of August, in 2 days. And our assumption is that it's going to take us about 3 years to do the renovations, to replace some tenants, update those leases to get to what we're predicting in terms of what we can get per square foot over that 3-year period. And we look at the refinance, and this is kind of where you learn how to take some money off the table, which is we're hoping that 36 months from now, we're seeing that rates will hopefully go lower, but our expectation is the days that we have enjoyed over the last 10 years where interest rates were incredibly low are gone.
You're not beating me right now. These two are combining to have some of the most epic home runs at this Little League World Series.
Well, and think about this, Todd. I mean, this is a miss hit. This is a pop fly for most average Joe hitters, but he is so strong, and even though he gets underneath it,
we don't see that happening again anytime soon. And so we went from a 7% rate, as you can see here, down to a 6% rate. And same amortization period, a little bit lower of a financing fee. But as you can see here, the NOI at the refi is much higher, and the property value has increased from our $27 million purchase price to about just a hair under $36 million. And so the debt yield is even safer now, because our increase in the NOI, even though we're taking out a little bit more money, it's about a $7 million difference, $6.5 million difference. We have a higher capacity in terms of debt service. As you can see here, we're just a hair under 1, and we'll be at 1.32 by the time the property refinances. From a investment period perspective, our goal here is to hold the property for about 6 years. And so as we continue to make certain assumptions, like here, we are assuming certain amount of rent growth, how much our expenses are going to grow, what vacancy might look like. This is a very robust market, so we're not too concerned about vacancy because of the demand in the area. not a whole lot of new product being built at the moment, and other income opportunities we're looking at. But as you can see here, from the hold period, we're looking at, exiting in 6 years. And so by the time we get to our exit net operating income, we're at $2.8 million compared to from where we just started. And then as you can see here, we're thinking about an exit cap at 6.25, pretty conservative with our cost closing. And so hopefully the net exit value is just a hair under $45 million from a $26 million purchase. And that kind of takes us back to why you see these numbers here in terms of the returns. So your equity multiples are basically how, we basically doubled the money over that 6-year period unlevered. It's a little bit juicier because when you're able to use leverage, that means you're using less of your money and more of the bank's money to help generate a higher return. As you can see, the internal rate of return without any leverage is 14.4, whereas with it, it's about 24, just a hair under 23.4%. And then we look at overall, it's about 19% IRR. But those equity multiples are very nice especially for check writers, private equity funds, or family offices who are looking for opportunities. This is a pretty attractive transaction based on the assumptions that we're making. Looking at the waterfall and fees here, there is a first hurdle at 10%, which basically is kind of a risk management feature for an investor, the limited partner. In this case, we're the general partner, and the limited partner is going to get a 10% preferred return. So before anybody gets any money, the limited partners, the people who wrote a majority of the equity portion of this acquisition, are going to see money first. And then assuming we hit that hurdle rate, then once we get to that second hurdle, over the pref, then it will be split 80-20, 80 to the limited partner, the big check writer, and then 20% to us as the general partners. And as you can see here, the equity multiple is still at 2.3%. The IRR is at 19. And when you look at the net cash flows, for years 0 and 1 is where we're acquiring the property, doing the renovations. As you can see here, there's the budget, the capital expense for renovations at $750,000. And so when you look at the net cash flows to determine your internal rate of return, you take these 6 numbers from year 0, 1, 2, 3, 4, 5, 7 numbers. And that's how you calculate your internal rate of return. So you've got some money out, year 0 and year 1. You make a little bit of money on year 2. Year 3, we do a small refinance, so people are able to take some of their money off the table, and we hold it for a little bit longer, do a really good job managing the property, and then we exit in year 6. So by the time we look at the outflows, these are year 1 and 0 and 1, and the inflows, which are these numbers here, your net cash proceeds for the whole period are that $16 million. So we really like this transaction. I'll show you kind of how we're excited about this in terms of where the opportunities lie. And so as we mentioned here, there are several leases that are expiring, and as you can see, to go from $9.37 to about $17.55 over a certain period, that's where you're going to create these values. So you can see it's a pretty badly managed property. It looks like there wasn't a whole lot of interest from the current owners because it's such a small part of their portfolio. Maybe it was too far away from where they lived, and so they couldn't do the type of management that's required to make sure that things are done well on the ground. So, some of the things that we've done during the tour is we really took time to really inspect every nook and cranny of this property. What we liked was there's no sagging walls, no cracks in the walls. We did see some things with drainage. Some of the storm drains were not functioning properly. We'll have to do some recoating of some of the roofs, but we do have time to look at all the warranties for ones that were done recently. It looks like maybe 1 or 2 roofs are left to be done, and hopefully it's just a coating job versus a full replacement. And then hopefully the storm drains, whether it's a sewer system in the municipality or maybe they treat the rainwater on site. Usually there's a dry well or leaching fields. So it looks like maybe some of the wells have collapsed and are just not functioning properly. So these look like neglect, not structural issues where you have to be concerned about, man, am I buying myself a money pit? These are just things that are just kind of typical wear and tear, especially if you're not paying attention to the property. And we've already ordered the phase 1, so we should have that soon. And we're looking at we've already doing some of the tenant review, and we're seeing that some of the tenants missed their 6-month notice for renewal, so now they're month to month. Some are anxious, have made it very clear they're anxious to stay, they're not looking to leave. And some who want to stay, but we see that it could be a potential problem tenant. Maybe we'll have to have a good discussion to understand what their needs are and if they fit what we're trying to do for this 6-year hold period. We have some existing relationships with lenders. Thankfully, that's kind of where I bring value add, because that's where I specialize, which is commercial real estate finance. And so we should have some term sheets this week, early next week, to help us confirm what we're putting into this financial model. And we've also talked to brokers outside of this transaction to kind of see if the product that they have now is of similar quality, whether it's a renovated version of what we're trying to make here. And the response so far has been very positive. So the product that's for sale now is at a higher per square foot than what we're buying it at right now, including the renovation cost. So the product for sale in this region is about $220 a square foot. We're potentially buying this at $165 plus the $5 per square foot that we'll be spending for the renovation. So we're comfortable with that basis, and the model is updated. We'll continue to update this model to reflect any things that we run into. There's an increased cost for the renovation to make sure that that's going to meet what we have been projecting and proposing to our potential limited partners. Going on about 18 minutes now, and hopefully you haven't all fallen asleep. You're enjoying learning with what I'm sharing with you. And I think the last thing I just wanted to show you is what these projections actually look like. So what we'll do is we take these numbers here, as you can see, the rent growth, expense growth, the general vacancy, and we plug those in to where we look at the information. Now we'll look at 2 years or 3 years of historicals. We'll look at the year to date to kind of see what anomalies were out there, see if there are numbers we can pull out, like capital expenditures, which are non-recurring things. So a roof replacement, a major plumbing job, a huge electrical job. Those are kind of things that are one time that hopefully will last a very long time that you're depreciating. But if it's just having an electrician or plumber come out to fix a toilet or something like that, those are just typical maintenance and repair costs that you would put into your operating expenses here. But a lot of these leases are triple net, which makes this deal even more attractive. But you see here, we look at all the operating expenses, the taxes, the insurance, the management, etc. And those line out into our total operating expenses to get us our net income. And we make sure we're budgeting for those tenant improvements when those leases expire. The leasing commissions, we got to pay those brokers because they're out there making phone calls, talking to potential lessees. It's a lot of hard work. So we got to make sure we pay our brokers. We have a reserve. And as you can see here, there's that $750,000 for the capital improvements that we'll do in the first year. And so as you can see, these numbers really help an investor really understand kind of what we're doing, and they can maybe show us things that we're missing. Maybe they'll see things that they understand that we don't. Highly unlikely. Pretty experienced group of guys that are trying to take down a $26 million transaction. But as you can see here, these numbers really help you to understand beyond what you might see on a single page flyer. So if you ever need assistance looking at a potential property, happy to be a resource with your financing across the capital stack, from debt to equity and everything in between. My name is Marcelo, and this is Profit and Pitfall. I'm the CEO of Shokunin, and you can click on this link here if you ever want to make an appointment to talk about a deal that you're looking at to see how we can help you. Thanks for watching.